Hey, what's up guys, it's your boy 007 here to do another review on the stock market outlook going forward next week. So last week we wrote on the notes that the money flow was flying out of the market in SPY, and the RSI over here was crossing over to the downside, which means it could be bearish. And we see a move back to the 377 levels. However, on Friday, there was over $1 billion on the buy side. So that was last Friday. Even though there was some buying, we actually did end up getting pretty close to the 377 level. On Friday, we hit about 378.23 cents. Just kind of missed it by $1, give or take. But it was pretty close. The technical indicators played out really well as we moved to the downside. So as far as next week going forward, I think we could see a move back up, just like how we had over here in February. When we kind of hit this line, the second support line right here, and we moved back up from here, to make new highs. So we could see the same thing here as we got the stimulus bill passed, and everything started going bullish again, because we had a pretty good pullback already. So as the RSI started to bottom out to a very oversold conditions, we should ideally bounce back up here. Same with the money flow, we could see that coming back soon, but it hasn't come back yet, but it's at a very oversold area. Next thing to take a look at is the QQQ, the tech sector. The QQQ looks weak as well. That's what we said last week. Under 327, we can go to 318. And however, all the tech ERs was extremely bullish. So that's what happened. We went under 327 and we hit 318. We actually hit as low as like 311. Even though we closed around 315. So that was pretty bearish. I still think this is a really good support line right here. This support line was built from highs of September 20th. So I think as long as we remain above that 308 area, we should be able to, the overall market should be bullish, and we should be able to bounce back up and make this move back up from here. That's what we're looking at. Above 308 equals bullish. So on the thoughts on QQQ this week, the tech sector has dropped a lot due to sector rotations. The sector has gained about 40%, compared to the pre-COVID levels of over here. So if you took 236 times 1.4 for 40%, that's what QQQ was at when it was all-time high here last week. So the tech sector has gained about 40%, the SPY sector gained about 15%, and the financial sector had only gained about 5%. So it's only fair to let the other sector catch up, such as the energy sector and the travel sector as well. So those are some things that was pretty normal still, despite the fact that they had really good ER. The other sectors were lagging very hard, so it's only kind of natural to see money flow into the financial sector, which is something I've been playing the last month. I've been talking about it. I called the run up here, I called the run down here, and we called the second run up as well, right? It was almost too easy because financial sector is the third biggest sector, in terms of the market. So XOF performed extremely well as we predicted 2 weeks ago. Could back test new support at 31.6. That's what we said last week, and they still continue to perform extremely well, and I'm still looking for them to back test that 31.60 area. So here's the thought on the financial sector going into next week. Financial sector has had an amazing 17-day run. So all these green bars are 1 day each, right? So we have 17 green bars. That's a 17-day run. Look for that pullback now, which we kind of got on Friday. we saw that pull back a little bit, something we were expecting for a while already, because it had such a monster run, right? And anytime something had a monster run, it's got to cool down a little bit. It's only natural. So we're going to look for that pullback to come back to, around 3160, maybe even 3050 at worst case, before we get another leg up further and going higher, for the financial sector. So look for same plays as like Bank of America, PRU, and all the other stocks as well. And lastly, we got the dollar index. Last time I said it was setting up mixed signals. Could be setting up a bearish head and shoulder pattern, which would have meant, bullish for the market. So this was the head and shoulder pattern that it was setting up. But then on Friday, it moved back up, signaling kind of bullishness for the dollar index, but bearishness for the market. So going forward to next week, I think the dollar index, I'm gonna call it here. I think the dollar index is making the last stand here as they try to jack up interest rates through bond yields. But with stimulus around the corner, dollar index should die. Economy hasn't recovered enough for interest rate hike yet. So that's something that's been speculated a lot this week. We saw a lot of talks about bond yields going up and bonds selling off, and people are confused. A lot of people didn't understand this whole, back and forth between the bonds market. So I'm gonna explain that a little bit more. So the bond yield going up, is just that what bond yields is in general at first. It's the return an investor realizes on a bond. So the bond yield going up would actually make it more lucrative for somebody to buy bonds, right? So this is a 2-year bond yield over here. This kind of tracks it over here, and the 2-year bonds at 0.17% interest. So that's less than 1%. It's 0.17. The 10-year yield has climbed back to. Let me change the candle a little bit so we can see it better. So the 10-year yield has been spiking back up like crazy. It dropped in March because the Fed, said, hey, we're gonna do 0% interest, right, for the next few years. So that's why it dropped to 0.5, which is reasonable because there still should be a slight premium on top of that. If it dropped to 0.0, then mortgage-backed securities wouldn't make any money. So that's why it's been in this area. We still don't expect any inflation coming in, inflation control coming in. So there shouldn't be any interest rate increase going until like 2022 or 2023. That's the general opinion right now, and that's something that's been pushed by Powell as well. He said that no interest rate increase until 2022 or 2023. They don't see it coming, but the people that are holding bonds, they're not making money. A lot of people are selling off in bonds because why would you invest in such a safe haven asset when the stock market is going crazy? Stock market mania at all-time high, with GameStop and all these other stocks making people so much money. Everybody want to participate in the market, right? So obviously they're going to sell off their bonds and put their money in more degenerate assets. And even a month ago, we talked about how the junk bonds were being bought up too. We saw a huge buy in junk bond, because that has better interest rate than the 10-year bond, right, or 20-year bond. So we saw a huge interest in that. So people are like, getting a little bit more risky assets because the market looks like it's fine. It doesn't look like we're gonna collapse. Doesn't look like we're gonna, have worse than March levels, give or take. So that's why people are making these moves. So seeing the bond sell off this week was something that was natural. It's good for the market. Obviously, people are gonna go more degenerative because they've been playing so safe for so long. They thought the market was gonna collapse due to COVID, and it didn't collapse. And market is all-time high. So obviously, people are gonna make these moves, right? But some there are role players, that out there that want to make the interest rate go up, so they're spiking the bond yields, through these technical manipulations, and that's why bond yield has jumped back to 1.5%. If bond yields continues to jump back high or remain high, then it's gonna be bad for people wanting to get mortgages, because mortgage rates are gonna be higher. That would make more people trying to buy real estate. That could create another real estate boom as well if this does continue. But I don't think it's gonna continue as well. I mean, this continuing also would make people want to buy back into bonds as well. Because higher interest rate would mean less people want to invest in risky assets, and then they'll go back to investing in TLT, right? But TLT dropping this whole time is natural. It actually should have dropped faster, because check it out. Dated all the way back to, pull the chart. Dated all the way back to the last crisis in 2008, 2009. This TLT, which is a 20-year treasury bond, jumped up as well, right? Everybody put their money in that safe assets, and it jumped up really quick, and then it came all the way down. It jumped up quick because it was high demand, and then came all the way down because everybody sold off, right? Because people don't want to invest in that safe asset anymore. They want to start buying the dip. So it's only natural, when things start recovering and markets start recovering, the TLT goes back down. So that's what happened here, went back up, and it took a while before it started coming back down. Obviously people are going to sell off because market is doing better, so it's only natural. So all these bearish talk, all these dumb people talking about, TLT should be, higher or whatever, it's retarded. It's not going to happen, not unless the stock market keeps crashing. If the stock market keeps crashing, everything's going down. We don't want that. I mean, this could bounce a little bit, which should be a technical bounce here. If this bounce up here and then just chop around this level, that's fine. Shouldn't be up here. No reason to be there. So that's pretty much the coverage on bonds, and helping you guys understand a little bit more. I hope that was a better explanation than all the fake news going around and trying to really scare people, because we have had this issue multiple times. There's quite a few times we had a yield curve, and the market has always dropped every time there was news of a yield curve, right? But every time the market dropped, it would cover right away. So don't be too worried about it. We also got the $1 trillion, $1.9 trillion stimulus package that got passed. So that was something that's really, bullish. I think that's pretty much it, man. That got passed in the House, so we're still waiting for that to pass in the Senate. Vaccine got increased. They're also looking at possibly doing the minimum wage increase. If that happens, that would be a really good inflation. And high inflation is good for the market, because if there's high inflation, then people, if they're gonna increase everybody's wages to $15 or $13 in the next few years, right? And the cost of goods is gonna go up. So if somebody was spending say they were spending $3 to buy a cup of coffee, and they were paying the workers like $7 to make that cup of coffee, now suddenly they gotta pay the worker $15 instead of $7, right? Now that cup of coffee isn't gonna be $3 anymore. That cup of coffee or that cup of bubble tea is gonna go from $3 to $5. So what that means, if you had held $1,000 in your bed or in your safe deposit or whatever, throughout this whole time, your emergency fund, if you were saving $1,000 emergency fund, in your safe, and you used to be able to buy, let's say, you used to be able to buy $1,000 divided by $3 per cup of coffee. You used to be able to buy 333 cups, right? Now, if it goes back to $5, if coffee goes up higher to $5, you're only gonna be able to buy 200 cups. So your purchasing power is gonna be weaker. So what do you do to, combat that lower purchasing power? You're gonna invest in assets that go up over time. You're gonna invest in stocks and stuff, so that your $1,000 next year would be worth like 1,200, 1,500. To fight that inflation. So that's why it's gonna be good for the stock market, because stock market is one of the only few things that give you a higher rate of return than certificates of deposit and all these other stuff. And it's also going to be good for the real estate market too. So that's something that's going to be pretty interesting that we're looking forward to. The only other thing that could really affect the market, now I'm still somewhat bearish in the market because I do think that, you know, the market has ran up a lot. So naturally, it would be reasonable if we do have a bigger pullback to maybe even like $300 levels on SPY. But that may or may not happen. Who knows? You know, you can't be a bear forever, because naturally the market do go up. But the thing that could make that happen, the anomaly that could make that happen, is if we have you know, crazy move or, you know, multiplication in the variant, the COVID variant, you know, where the vaccine is unable to treat it, and we end up getting a really bad fourth wave of like COVID surge. That's something that could put us in shutdown for longer. If it puts us in shutdown for longer, you know, it could roll back and set back everything, especially if the vaccine isn't able to deal with that. But so far, that's not the situation yet, so we should be okay. The other thing I could see coming that could be a little bit wild would be, you know, this whole semiconductor shortage. If this thing goes on a little bit further and all the companies can't manufacture cars or anything that requires these chips, and it will set back the manufacturing delays and everything. If manufacturing delay gets, you know, becomes something that's a real issue, then that means economic activities would be weaker. So that would overall could drive the stock market down as well if economic activity is weaker. But overall, I think we should be going back. Last week we talked about a few stocks that are still pretty interesting buy. In terms of safe assets, or like MKC, I think this is still a pretty good stock to buy. You know, it's falling back to this really good trend line here, sitting around $83. I still think it's a pretty decent opportunity to get in. Another stock I actually looked at this week was also Apple. You know, despite the talk about tech getting rotated out, there's still a lot of bullish catalysts for Apple. And I'll tell you why. This chart pretty much covers everything on it as well. You know, this is the kind of the RSI oscillator, and it's kind of showing that it's very oversold. So that means if it's extremely oversold, that's usually an opportunity for buyers come in and pick them up and make a small bounce. So we could see some bounce over here to 128 areas, maybe 130, possibly even 140 plus if market continues to be extremely bullish, right? Same with the money flow indicator here. You can read the chart here. Currently the price of the stock is falling, but this is rising, you know, which means there's buyers coming in. And we're also at a really good support level over here at the 120 area, 121 area. You know, if we can hold this area, and then it should be able to bounce off this area and move back up. So those are two interesting trades I'm looking forward to for next week if market continues to be bullish and, you know, everything continues to play as we plan out. But other than that, I hope you guys have a great weekend and good luck next week trading, man. Hope everybody makes back the profits because it was a really rough week overall. And you know, if you guys have any questions or anything, feel free to message me on Google or Discord. Take care and have a great night.